Welcome back to the channel. Today I'm going to be making my predictions and forecasts for 2023. As all of you already know, I do have a crystal ball, and therefore I've definitely got the skill set and obviously the credibility to be making such a forecast or a prediction in this year, and really it is a lot for fun. But if you find value in this video more so than my other videos, then please drop one of these, as it does help out a lot to show new viewers what is good content and what isn't, because a lot of the stuff I have uploaded lately has been utter garbage. Or am I lying? Anyway, so today I'm going to be predicting that stock market, and what really are my predictions for 2023? Let's start with obviously the stock market. At a completely speculative level, I feel that the stock market's going to decline for maybe the first couple of quarters. And then I think we're going to have a bit more optimism once the worst of the damage is seen, and I think at the end of the year or nearing the end of the year we're going to see more of a relief rally, and I think the stocks are going to be looking quite favourable in that period. However, it certainly means it's going to be tougher times up ahead, in my opinion. As for the economy, I do believe the economy is going to struggle with GDP growth. However, I think the stock market is already factoring in a lot of this, and therefore that's why I think whilst the stock market might recover, I do feel here that the economy is going to contract further, and I've got some risks that I'm going to mention. So what are the potential risks and concerns for 2023? What am I worried about, or what do I think is going to be at play impacting our investments in the stock market? Well, particularly in the UK, we've got a lot of strike action at the moment. We've got the likes of the ambulances, we've got the likes of the Royal Mail, G4S, for example, and even the train lines. So there is a lot of disruption already in our economy. A lot of those means that, especially for the likes of a lot of those delivering physical products or services, that things are going to be tougher. Obviously, we have now transitioned, especially in the last few years following the pandemic, to a lot more digital services. There are still physical products that need to be moved from A to B, and with obviously train strikes and with the likes of Royal Mail strikes, this is going to slow the process down, especially if you're an online retailer named Boohoo, where you've got to be doing deliveries, and Royal Mail obviously isn't partaking in those deliveries for that day. So I think it's going to contribute to the overall disruption that we did see this time last year, and because of these delayed delivery times, there's going to be some more concerns going forward. Energy prices are going to be a big factor, as they have been for the last year. Whilst energy price futures infer that prices are actually dropped now in time, the issue is at the moment is a lot of the energy companies have, and again, I'm not in the energy sector and I'm going to be saying the wrong words here, but they've effectively acquired this energy at a higher cost basis, meaning that they've still got to sell off their current reserves of energy, however that is stored. And then once that has been sold through and they've gotten through that, slog, or let's say inventory in this case, then the prices will start to come down into line following the futures. So at the moment we're going to be seeing extended high energy prices for some time, and I do think this is going to impact some businesses that were fortunate to fix their interest rates prior to the pandemic. A lot of companies at the moment are doing a lot with options, and they're trying to obviously negate any further changes to the interest rates, and some that were fortunate did fix it. However, I do think some of these options are going to expire. There are some notable companies whose energy would have been fixed prior to the pandemic that is going to expire during this year, and I think that's going to show a lot of trouble. Although the stock market would have likely already priced this in, especially if they would have known in advance, which is what the board of directors would have told you, I do think there's going to be some concerns there. And I think overall, in real terms, the businesses are going to be struggling, and the profits are going to become much more of a focus. So I'm looking primarily here at the hospitality industry, services in that regard, because obviously they're going to be using lots of energy, and energy is going to be a core cost of running the company, alongside the likes of obviously wages and other means. And you've also got the likes of the high street retailers, who are also going to struggle here in line with that, because obviously you've got to maintain their stores. There's obviously going to be other businesses that are impacted, the likes of industrials, for example, those running warehouses as well. I wonder how the Ocado automatic warehouses are doing. I imagine the cost of that strongly outweighs the energy prices, but again, there are some things to think about here, and dare I even mention the likes of Algo Blockchain, for instance, the Bitcoin miner that had the cheapest energy rates in the world. Well, I think that energy price has certainly been increasing nonetheless, although they have got a whole basket of concerns that I'm not going to go into today. So inflation remains high, especially in energy, as mentioned, as well as food. I personally think that inflation is going to start to weaken over time. And I think that headline figure, I think we've peaked already, and I think that's going to slowly decline over time. However, there's going to be very much a pivot point, and in that pivot point, I strongly believe that it's going to flip the other way. At the moment, we've got the central banks, they're hoping for a soft landing, meaning that we can get interest rates to a certain level and we can get inflation back to that target of 2%, or they'll be happy with 3%, I imagine, and that would be great. However, I think it's going to flip the other way very quickly, and I think the central banks are going to have to be, let's say, quite fast on the downturn. So what I mean by this is when inflation starts to pull back and we're seeing a lower rate of inflation, I think they've really got to start reducing interest rates, or I think they're going to realize that then they're going to have to start, cutting back on interest rates. So I suppose from another perspective, if you were looking at savings accounts at the moment or interest rates on bond yields, I would think now or this year, at this time of the year, I think this would be an attractive rate. Now, I'd love to see how this performs in the next year. I would wonder to see if in 2024, if interest rates are even higher, if inflation is still high, because that would be interesting there. Because again, in the 80s, right, you might have gone, yeah, bond yields, fantastic at the moment. Let's fix here. For all you know, it could have gone up, it could have gone down. I mean, I'm sure there would have been more on the basis of research rather than speculation, but the point still stands. And as I say, as costs continue to hit profits, we're going to have some concerns. Companies are going to look to cut back. Where can they cut back? Well, firstly, they can streamline operations. And that seems to be the agenda on a lot of the annual reports at the moment. Streamlining operations, really making operational efficiencies, all of those key words, right? However, there's going to be other things here. Once they realize they can't streamline any further and they can't build volumes as much because there's reduced demand, well, what are you going to do? Well, you're going to go, okay, what is one of my largest cost basis? Is it wages? Okay, if I've got a lot in core wages, how can I mitigate this, especially as inflation is driving up wages? I mean, admittedly, not in real terms. In real terms, I would say that wages are falling below that. But again, wages are being driven up by inflation. And if companies are at lower profits, that means their profits are going to be eaten into even more by that expense. And I think we've seen already in the likes of big tech, excuse me, I got something in my throat, where basically they've been laying off a lot of employees, and even Google, I think, laid off 10% or were looking to lay off 10% of their workforce. So that could be another concern going forward. And whilst you go, okay, this is great for those companies, right? Google, for instance, with their advertisements, if they're cutting back on their employees that are very expensive, then great for them, right? That means they're going to get easily much more profits. And that might work in favor for the big tech companies. However, we're going to see reduced discretionary spend, I believe, as unemployment starts to rise. And I feel that in that case, it will happen if companies are having to make lay people off in order to stay surviving. And I think obviously we're going to see reduced spending, as I've mentioned, and that contraction in demand going forward into the year. So I think things are going to look a lot more grimmer, but I think always it's got to be darkest before it's dawn. And now I don't know, again, because normally I look, and what I care about truly is about the next 10 years. But again, that's kind of where I'm forecasting in the next year. I think these wages are going to be a concern, and these larger businesses, the ones that have a high level of wages, are going to look to cut back on that where possible and, really focus on profitability, especially if they're a public company, because that's what the shareholders are after. So what about my companies in the portfolio? How will it impact me in this next year? Well, I think Games Workshop will prove to be very resilient. I think recently their deal with Amazon where they can produce, I think it was a TV series or a film using their intellectual property. I think that's a great thing, right? That really can only be a positive benefit to the brand of Warhammer and basically good marketing on their behalf with a very profitable line of income due to the royalties. Royalties have minimal expenses at that, and therefore pretty much all of the revenue of royalties, a majority of that will come back as earnings. That's great for the shareholders. Not only is the brand becoming, more widely known and accepted, especially when it's on Amazon, especially if Henry Cavill, whatever his name is, the guy that played Superman that's no longer got that, will get on board. I think people will very much like that. And that's good. More profits, more dividends, higher anticipated shareholder returns as there's more perceived value in the stock. So I think Games Workshop will probably do quite well. Boohoo, I think, will likely continue to struggle as it's trying to fortify its recent acquisitions. You've seen the likes of Dorothy Perkins, Debenhams, Burton, all of that. And I think at the moment that they probably didn't anticipate as much of a struggle as it has to push these into profitability. But this is something that Boohoo is extremely competent at. It's buying businesses that have gone bust or were going bust or were, no longer worthwhile as businesses and turning them around. So at the moment, whilst they're incurring large losses, I think that's going to pivot around at some point. And I think they're going to do well in the more medium-term aspect. And I think in one of their comments as well, they mentioned that they were extremely confident in the outlook for this and that they, it's what they do effectively. However, I don't know in terms of where the share price will be. I think it's going to be a very volatile year because Boohoo, really, it's always up or down 10 or 20%. The moment it's gone up 10%, the next day it's already lost all of its gains, which is always quite amusing and quite fun to watch. So realistically, I think there's going to be a lot of volatility. volatility. I think people that are trading the stock might be able to make some good money, but over the course of the year, I don't think we're going to see that much of a movement. We could do, and that'd be great, obviously, if we see a large movement, especially in the upside. But again, I don't think we're going to see too much, especially as there's a lot of perceived risk from the shareholders. Although, in my opinion, with a balance sheet like they've got, it's very unlikely they're going to go bust or bankrupt. And I do think they've got enough cash flow to stay alive. But again, that's down to the opinion of other shareholders or other investors in the markets at the moment. And when things start to return to a more of a positive normality, I think then that's when the shares are going to start to recover. And I think in that same aspect as well, I'd be looking to buy shares in Boohoo once we see some more positive news, or once we finally see some positive news. Once that is priced in, okay, look, Boohoo, let's say they've got a return of high demand, bang, there might be an instant 30-40% increase in share price, which you might go, that's ridiculous, but truthfully, that's not unlike Boohoo. And then at that point, I'd reassess the business, I'd look at the valuation, I'd look at where they'd be expected to be and go, okay, right, I've held on to this stock, now could be a good time to average down. Sure, I missed out on the very bottom, but that's okay because I was investing in other holdings. Speaking of other holdings, I've recently been buying more of London Stock Exchange Group. I think it's a very strong company trading at an attractive price, especially when you value it at price to free cash flow. As of right now, I am buying more, and I will continue to build this position up to about 10% of the portfolio. It's very resilient, it's a very defendable company, and I think I might actually see a positive return on this stock in this year. I'm also going to be buying some more stocks in the next year. I'm going to be aiming to get 2 or 3 more holdings, flesh out smaller positions, nothing quite to the size of Boohoo or Games Workshop in the portfolio, but certainly start to build them up. I may even continue buying some more Games Workshop, although it's very pricey at the moment because I do think it's probably the highest quality company that I hold with the most growth potential. But again, I've got to weigh that one up against what I believe their cash flow will be in the future. But that's how it is. Hope you enjoyed this video. Have a fantastic day.